Thank you very much for inviting me here, and I think that's probably the first time I have ever known up front how much of an uphill struggle I've got from the very outset. But I am very pleased, nevertheless, to be here to share some of my thoughts on Europe's role in constructing growth for small and mid-cap companies. And I'm delighted that actually both the QCA and the SME sector as a whole in the UK are now actively engaging with the EU on this issue. And given the increasing role that the EU is taking in matters of concern to all of you as members, it's really important that you actually do stop and ask the question now and again as to what Brussels is doing on your behalf to build an environment in which SMEs can grow and flourish. And in the wake of the financial crisis of 2008 and onwards, the EU has sought to regulate the financial sector with the purpose of making the financial system crisis-proof, which I suspect is not possible, and to reinforce confidence in the European markets, particularly the European financial markets. Now, the aim of this barrage of legislation is not to increase the regulatory burden on commercial issuers, and particularly not to increase the burden on small and mid-cap companies. But this, unfortunately, is often the unintended consequence of some of the work that's going on. And we need to ensure that all the stakeholders are consulted and that we achieve better regulation by actually doing proper cost-benefit analysis for any piece of legislation that we have out there. And we have something called the small business test that we have to insist is being applied at every single piece of legislation to make sure that legislation is tailored where possible so that we can actually exempt smaller companies where appropriate. Now, despite the rise of the EU as the source of most of our regulation, which quoted SMEs have got to deal with, national governments still retain many of the levers through which they can support the sector. And it's important to identify where the EU can play a role and where the national parliament needs to step in. And for this reason, my comments this afternoon won't just be about what Brussels is doing, but I'll also refer to some of the things I think my own UK government can actually do to provide quoted SMEs a more favourable environment. And I can assure you that I'm actually taking these to the ministers directly to make sure that my voice is being heard, and those of the SMEs who come and talk to me is being heard directly in Westminster. Now, back in my constituency in Wales, I often actually get asked, why is it important that small and medium-sized companies flourish? Isn't it better that we should have big companies come to Wales and to other areas of the UK to actually invest and give us jobs? Now, it's a really difficult one for me because Wales has the vast majority of its employment in SMEs. And that actually is true of almost all of the EU, no matter which member state you look at. SMEs, quoted or not, form an integral part of the European economy, accounting for some 99% of enterprises active in the Union by number. And they employ approximately 2/3 of the European workforce. Now, if each and every SME in the Union employed only a single person extra to their workforce, full employment is within reach of the entire EU. Now, the Commission's correctly identified this, but now you have to ask the question, what are they doing in order to try and encourage that to happen? Now, Europe needs the growth potential of SMEs, and we need to facilitate, in particular, access to finance. And many of today's corporate champions in manufacturing, IT, biotech, whatever field you want to choose, started out once upon a time as small entities. And by not giving their successors means and access to capital for their businesses to grow, especially access on a fair term to the capital markets, Europe would actually be knowingly taking the risk that the next Zeneca or Rolls-Royce or any other large entity that we're proud of in Europe will be founded in the US, Brazil, or indeed across Asia, rather than in any of our cities here in the UK or in Europe. Now, a stock market flotation can be critical to the steps needed in developing from an SME employing a few dozen people to actually getting to the globally active firms employing thousands, tens of thousands. The growth of companies like the high-tech industry in Amazon and Google would have been very, very unlikely had they not been able to access capital market funding on relatively easy terms. Now, the difficult environment for quoted SMEs, on the other hand, is frequently cited as the reason for the advantage that the US has over Europe in developing these companies and commercializing all their innovative technologies. Now, a very short while ago, the studies showed that SMEs accounted for 40% of live patents in the UK. And it would be absolutely disastrous if we actually didn't harness the entirety of the potential commercially of that intellectual property because of lack of funding. So in this context, I think I actually have to stress that well-regulated secondary markets can also have a hugely positive influence on primary market activity. And policymakers will not participate in IPOs and invest in our European champions in research and technology in the first place if we're actually stifling our secondary markets too much by regulation. But on the other hand, our markets have got to perform efficiently in order to have those investments from around the world being made. So why would firms want to list in the first place, given that there's such a large, complex array of regulation they have to deal with, and they have to comply with all sorts of rules for the exchange or for the MTF, and they have a major cost impact upon them. And in fact, a vibrant market for SMEs influences even the funding of companies who are not seeking capital markets. Because at the end of the day, venture capitalists and other private investors need an exit route. And if they can see one in the form of capital markets, then they will actually typically invest more capital. Now, whilst SMEs in general in the EU receive an awful lot of attention, the policymakers are rarely differentiating between SMEs in a high-growth category seeking access to capital markets versus those that have no need of them. And in fact, they lump together the financially sophisticated entities where high growth is expected and will be delivered with those of the grocers and the hairdressers and other SMEs on the high street. And too little is known across Europe about the way and the reasons why the SMEs access capital markets. We know very little about the European investment scene, and we actually don't even have a number that actually quantifies the contribution that the small and mid-cap listed companies make to the European economy as a whole. Now, however, what we do know about quoted SMEs suggests that their role is critical to economic growth. And certainly, it's critical to future innovation in all of our member states. And the UK is one of those countries where we do have data and we can study what is going on. And certainly, from what we're seeing at the moment, the SMEs account for 85% of the entire quoted sector. In some member states across Europe, it's 99%. So the SME sector is critical within that quoted number of companies. And in the UK, they employ more than 1 million people. So the data shows that companies listed on London's AIM market, the most advanced of the SME markets across Europe, actually grow in turnover and employment very rapidly in the first 5 years after listing. So we have to try and find how we can capture other companies so that we can get more than the current 12 billion that's being contributed by these AIM-listed companies to the UK economy. Now, simply quantifying the value that SMEs are adding as a positive contribution to the EU as a whole would actually be a very good first step to focus the minds of policymakers and to actually elicit further support for the SME market. Now, I've asked the European Commission to explain how it intends to close the information gap across these markets. And we need reliable information to identify where the problems lie before we can really effectively, as legislators, deal with this. And I'm hoping that the Commission is going to come forward with a response very shortly. Now, there are currently 3 separate DGs in the Commission working on SME financing issues. And we need to ensure that they take a holistic view. Typically, they're working in silos. We need to bring them together to make sure that what emerges is not a piecemeal effort, and we actually try and get some sense in purpose to the work that's being done. Now, as a consequence of certain pieces of EU regulation and indeed global regulation, there are going to be some new European capital requirements on both our banks and our insurers. And through the implementation of Basel III global requirements, we implement them through the Capital Requirements 4 directive in Europe and in the UK. And through the Solvency II that many of you have probably heard of, bank debt capital is going to become even more scarce than it currently is. Now, we know this is a consequence, but it's a risk that everybody are prepared to take in order to get safety and stability into the banking and insurance sector. But we need, therefore, to actually find other measures that we can take. Higher capital requirements may make the financial system safer and deliver a net benefit to European taxpayers, but it really does mean that the credit for SMEs will become even more difficult. So consequently, I think there's a recognition that SMEs will have greater potential if they're able to access equity capital markets and the bond markets. And they're going to actually thrive if they have other sources of finance rather than exclusively relying on bank lending to finance their growth. Now, Basel and Solvency II will actually punish equity investments, which is not a good starting point. It's going to punish equity investments simply because there will be higher capital requirements on banks and insurance firms holding these investments relative to the equivalent debt instruments. So we need to ensure that Europe is responding to the global standards in a proportionate way and making sure that when they do come into force, that we try, through implementation measures, to limit their impact and to soften the blow. Now, however, the time when banks have been lending freely to companies at fairly cheap rates is probably well and truly over, and I can't see a time in certainly the next decade where we're going to return to that level of bank financing as cheaply as it was. And in such an environment, it's important that we explore what can be done to facilitate the capital market access and to make instead the lives of listed companies a little easier. There are other EU initiatives that we need to be really careful about, such as the extension of the Solvency II regime to pension funds. If we allow them to do this, we are going to actually further disincentivize a group of long-term investors in our economy so that they actually also will be disencouraged to actually take long-term equity positions. So we need to make sure that the EU stops and looks at the impact on Solvency II on insurance companies before it starts to try and apply it to pension funds where the need is not shown. Now, finding access to finance remains probably the key challenge facing growing businesses in the EU today. But given the changing regulatory environment, corporate funding is having to become a lot more flexible, and companies are going to have to vary the way in which they seek their financing. And it does mean that we need to make these capital markets work better. Now, SMEs face two main challenges, and I guess when they come to list, you are probably far more familiar than I with them. But the high costs of doing so are critical, and the low liquidity is a real big issue, as you've heard, I understand, today from other panelists and other speakers. Now, listing and legal disclosure costs reduce significantly the amounts that firms can raise at an IPO, and often even apply on an ongoing basis, so it's a real disincentive. And since many of these costs are actually independent of size, the smaller your listing, obviously, the larger the impact of these costs. So we need to find ways in which we can actually try and help this, and try and find ways in which we can actually mitigate some of the impact, particularly of things like accounting standards and the audit requirements on listed entities. We also have a large barrage of corporate governance requirements coming through, and I think smaller listed entities need to have some certain exemptions in there to make sure that the burden there is not overly burdensome upon them. Now, we actually have to try and find ways of doing this. And there's a real problem that we actually need regulation for safe markets and to encourage investors globally to invest here. But actually, they have a detrimental effect. So it's all about balance. The actual markets-related dossiers for investor protection and the market abuse rules typically are shown to actually support investor confidence, and therefore actually investments are made despite the fact that the compliance requests go up upon issuers. But it's all about balance and proportionality. They're key to a successful SME market. And we need to pay a lot more attention to the actual equity market structures and the bond market structures so that we can adjust them to help the SMEs who are actually hoping to quote or are actually already listed. The major problem here, of course, is the illiquidity of the SME stocks. And since it's difficult, especially for large investors, to buy or sell small and mid-cap stocks without affecting the share price disproportionately, it does mean that they're trading at discounts often when they're actually trying to exit with block shares. It does mean that a lot of institutional investors are not investing at the rate that they might do so if these were actually simplified and made easier. Small and mid-cap liquidity is not helped by the lack of independent research, and it's the one item that is actually cited time and time again as the reasons why some of these investors are actually moving away from these markets. And also the absence of any widely used indices for the SME stocks is also actually having a negative effect effect, given that so much investment these days is being done through indices. Now, it does mean that we have to actually find ways around this, and I would suggest that given that the lack of research in the market is a structural issue and one of actual market failure, it does seem that the Commission could, at this point, if it so choose, step in and find ways in which it could directly fund a European SME research facility. There are calls for it, and I think it's something that could have some value to European capital markets. Now, many European policymakers are aware of the problems and are ready to acknowledge and support the SMEs in principle, because they obviously deserve our support and we need them for our growth. But the EU's regulatory environment needs to also support it. So the Commission is actually proposing all sorts of things with regards to SME financing and looking at ways in which it can actually assist. And it's certainly looking at its own venture capital fund right now to see whether or not it can help those pre the market actually find funding that's not available through European venture capital firms. And it does mean that with more reliable information about quoted SMEs, if we collect the data and the Commission go to task to actually collect as much as possible, it should be possible to tailor our measures in the future even better to the specific needs of small and mid-cap stocks, particularly the high-growth stocks within them. Now, I'd like to highlight some of the things that are actually going on, and would like to talk about the Markets in Financial Instruments Directive and Regulation, which you refer to as MiFID II. It's a huge dossier. There is an awful lot going on in it, and it's working side by side with the Markets Abuse Regulation and Directive as well. And both of these actually deal with market infrastructure and with the conduct of the participants that are actually taking place on that marketplace. Now, I'm actually a shadow rapporteur for both of these dossiers in the Parliament, and it's important to actually try and keep consistency across all the markets dossiers. And it's also important that we actually calibrate the legislation according to the needs of smaller companies. Now, MiFID II introduces in the current draft text an option for the MTFs, the multilateral trading facilities, to be registered as a new category, and is actually having a label attached to it called the SME growth markets. Such a listing, if we can actually get this category there, should enable us to use this category in the future to reduce the administrative burden on small and mid-caps listed on these venues, and could shift part of the compliance obligations to the market operators. Now, a new MiFID category also provides an opportunity for other legislation to then actually use this category to facilitate exemptions or special allowances for these markets. And so it's a tool. This venue will actually go a long way to giving the SME markets greater visibility in the financial marketplace, and will actually provide support to actually develop the small and mid-cap indices that I referred to earlier. The introduction of an SME growth market category will be the first step to make this viable, and subsequent legislation has got to support these venues and the companies listed on them, which is why in some of these texts I've actually introduced some amendments which call for financial services legislation in the future to be calibrated for these designated growth markets. We need to get the definition right so that these really are growth markets, and we're actually working with other shadows at the moment to make sure we have a market capitalization definition within it. Now, smaller issuers are obviously particularly affected by MiFID II because it impacts liquidity of shares. And one positive step in this respect is the fact that MiFID II extends the execution-only provision to growth markets, so another opportunity, which should entice some retail investors to invest more in these growth market-listed shares. And MiFID II should be seen as an opportunity for us politicians to move the regulatory burden away from the smaller listed companies and to consider the impact of all the market participants on stocks, such as those who are operating high-frequency trading strategies, and the role of market makers going forwards. Now, the Market Abuse Regulation, MAR, is proceeding through the legislative process in step with MiFID, and in future will be extended to cover all trading venues. So that will include the SME growth markets, on which many of the SMEs of the future and currently will be listed. But this is actually to be seen as a positive step on the basis that it increases investor protection and makes investments in quoted SMEs more attractive to a greater array of investors. But at the same time, it's positive that the MAR regulation stays in step and consistent with MiFID II in exempting issuers listed on the growth markets from direct compliance with certain of its provisions. Now, the Parliament is also working on the reform of legislation on initial and ongoing disclosure, and many of you will be very familiar with the prospectus and the transparency directives. Nobody disputes the merits of initial information and disclosures, and even though it can be onerous, there are measures afoot to make sure that it's calibrated so that SMEs are actually saved the biggest burden. And it does mean that when we have this category, we will have a certain ability to be flexible and make sure that a full prospectus is not required, but that certain disclosures are standardised and can be simplified. Thresholds and situations that require the publication of a prospectus have been defined at EU level, and they take into account the size of the issuer as well, and that's going to be critical going forwards. Now, these are all important steps in trying to simplify listings, to try and reduce the cost of listing, and to actually try and make things simpler whilst giving investor protection through the Market Abuse Directive. And it's all necessary for an effective regulated market to work. Now, in general, the regulated markets actually enjoy greater visibility among the investors. But we want to build an environment where small and mid-cap companies can progress and grow into those large companies on the major markets. So we need some form of transitional arrangements to be put in place too to facilitate move from an SME growth market to the main exchanges. Now, this, of course, is very costly to do, so there are ways in which I'm sure the Commission can come up with to try and actually ease that burden. So we are actually seeing a lot of activity. There's an awful lot of individual pieces of work going on. But we are actually trying, through things like the audit directive and regulation, through accounting directives, to make sure that the burden and the small companies test is actually applied at every stage, and therefore small companies have proportional application of these financial standards going forwards. Now, I hope I've actually not scared you all with all of this EU regulation that's coming out. Most of it, I hope, is actually trying to actually recognise there is a big difference on the regulatory requirements that should be applied to the SME sector. And of course, there are always rules and regulations we don't like, and I would dearly like the Commission to take hold of some of those and actually abolish them, though I suspect I'm going to be waiting a fair amount of time for that to happen. But we need investor confidence in Europe. We need to find the flow of funds. We need to find ways of actually accessing new finance for all of our companies to grow. And I think it's really important that our member states, if we have a category called the SME growth category, which is a formal MiFID categorization, then member states can use that in order to actually give exemptions. And in particular, taxation is one of those matters that is solely the competence of a member state and could probably make the biggest difference to SMEs and actually have the biggest impact in terms of trying to get these as active markets. The Parliament has actually passed a non-binding request for a financial transaction tax in Europe. Now, I can tell you I don't think there is anything that we have actually proposed in the Parliament that would damage liquidity more than putting a financial transaction tax on every trade. It does, however, look, thankfully, that the Council of Ministers have kicked it completely and utterly to touch, and it will not happen. And I do hope that the UK, amongst other member states, will continue to say it should never happen, because there is nothing that will harm growth in Europe more than applying an FTT at this point in time. It's harmful to growth, and it will be extremely harmful to the already illiquid small and mid-cap companies. Now, an idea slightly less controversial than an FTT would be to abolish stamp duty. I have to say, I don't understand why we couldn't, for the SME growth markets, actually have no stamp duty applied to that particular group. And I do think that we could actually very easily, for the SMEs, reform the tax deductibility of interest payments. At present, firms are obviously incentivized to issue debt rather than raise equity. And it would be really, really about time that we actually start to level up the playing field between the tax treatment of equity and debt. And it's really important that our own government here in the UK uses every tool it possibly can in order to achieve that. I think it's really important also to recognise that the capital gains tax incentives are probably one of the biggest ways of getting long-term investors to actually stick with the SME growth sector. And they've proved particularly effective in the past at attracting investment. Now, if the EU is successful under MiFID II in creating this new SME growth category, then this is the ideal vehicle for the UK and all other member states to stimulate the investment flows. Surely, in order to encourage the flow of capital, measures could be introduced that would allow an investor in a SME growth market company, or indeed an SME growth market index, holding a position for, say, 3 years or more, to benefit from a tapered capital gains liability. So reduce the tax the longer you actually hold the stock. Together with abolishing stamp duty on SMEs on these growth markets, I suspect that these will have a major positive impact on the SME market. Now, we are trying. We haven't got it right yet. And the one thing I don't get an opportunity very often is to speak to smaller companies at the same extent as I speak to the very large global companies who tend to have a presence in Brussels. So I will encourage you to not only ask me questions now, but to also approach my office if you have any concerns or anything you would like to have raised at either the Commission or within the Parliament. Because at the end of the day, the role of a constituent MEP is to actually raise those issues of the businesses in our constituencies. And if I don't do that, then that is my failing. So I will try very hard to represent you at Brussels and make sure we have good legislation for as long as we're part of the institution.
Kay, thank you very much. Has anybody got any questions for Kay? Because she's happy to take something. Look at this. Let's go to the centre of the room to start off, and then right to the back.
David Ragg, Safri Champness, Chartered Accountants. Thank you very much for your presentation. There's obviously a lot going on. You mentioned that Basel III and Solvency II is going to significantly reduce the amount of bank capital available. And that may even extend into pension fund investment. Given that the whole of Europe, in fact the whole of the world, is looking for, scratching their head at the moment, trying to find out how growth can be stimulated, wouldn't it be a good idea to put the implementation period for Basel III and Solvency II into a longer period? Because it's the last thing we want at this particular moment in time.
I couldn't agree with you more. I think it's exceedingly ill-timed, though my member states tell me that you have to actually consider the taxpayers who have paid the price of not having higher capital requirements upon the banking and finance sector as a whole. So it's all about balance, but I think there is somewhere that we can actually find a longer transition period for this. Unfortunately, in countries like the UK, we are already advancing ahead of most of the other member states in Europe in terms of the capital that our regulators are seeking people to hold. So we're already in advance in the UK and suffering more than other member states are. And I suspect there are many member states who will actually be very lenient in their implementation and will be a little less stringent than we will be as the UK in applying it. But I agree with you, yes, we should. Will we? I suspect not. I suspect that this is full steam ahead. We are at the stage, however, where the trialogue is being delayed. They were supposed to be trying to finish up tomorrow in trialogue on the CRD4, and I understand they've now put it off until July. So there is, I mean, it's nearly July already, so maybe it's not that dramatic, but I understand there is likely to be a much longer delay in getting the legislation through because of some big issues still. The real prize for us is to make sure that pension funds do not have Solvency II applied to them. And we are working at the moment through the Omnibus II directive, which actually ties in the Solvency II, and it's a strange mix of legislation, but we're trying to get ESMA involved in basically saying that there are some real problems here. We shouldn't be applying it to pension funds this early on. But it's all work in progress.
Okay, let's take a question at the back and then a couple of questions over here. If we do all three, and then perhaps Kay can pull all the answers together in one go.
Dr. Swinburne, thank you very much for your presentation. My name is Sarah Wilson. I'm Chief Executive of Manifest. We're a proxy advisor enabling institutional investors to vote their shares at annual general meetings. Unfortunately, when it comes to Europe, they can't. And while I'm delighted to hear that you're proposing lots of initiatives to create a pan-European SME market, my concern is that we're not actually enforcing the rules and regulations that already exist for efficient communication between shareholders and their companies. How can we possibly consider introducing new directives when the existing ones aren't even working?
Okay, let's pick up the three here. Pick up these three and see where we get to.
Hello, I'm Tom Shaw. I'm a lawyer and I head up our legal committee at QCA. When do you think we'll see the first growth market, SME growth market? I'm thinking in terms of cavalry arriving and whether they're going to be in the nick of time or not, if there isn't going to be debt finance.
Yes, Mark Ramsey, I'm a corporate financier. My question was also on the SME growth market and related to the definition of SME and whether it would include AIM companies or much smaller than that.
My name's Donald Stewart, I'm also a lawyer. I wanted to pick up on pretty much the same topic. I wanted to congratulate you on the fact that you'd made an amendment on the SME part of MiFID, and I think yours is the only amendment on the SME markets part so far. But you know, there are 2,300 and something amendments to the whole of MiFID and MiFIR, and it strikes me, having been to various meetings around the City of London, that in actual fact everybody's real concentration is on other issues. This is such a small issue. How are we going to avoid it sort of just being effectively swept off the agenda on the back of so many other seemingly much more important issues?
Good luck.
Done? Okay. The implementation of EU legislation in financial services has been really patchy over the last 5-6 years, probably beyond that. Ever since the first financial action plan, services action plan was actually put in place, it was supposed to be a single market. It isn't in the vast majority of cases. But what ESMA and the creation of these European supervisory authorities last year has actually given us is a mechanism by which we can actually force the implementation across different member states. And I'm prepared to give those European supervisory authorities the benefit of the doubt to make sure that they can get implementation. They're issuing codes of conduct at the moment, they're issuing guidelines at the moment for things that already exist in the current framework. And so I'm prepared to give them the benefit of the doubt that that's going to work. And in a year's time when I come back, if they haven't actually done that, then I will actually take up your point for you. But at the moment, I think it's a case of making sure that they have the tools available to them to actually try and get that implementation. With regards to the SME growth market timing, it's part of the MiFID documents. We, in terms of timing, hope that the committee will actually get this through, despite the 2,000 plus amendments. We're hoping to actually have text on the table that we can vote on in committee on the 9th of July. That is not that long away. So we are hoping that the Parliament will shift at that point. The Council haven't moved quite so quickly. There are some major political issues they're actually grappling with, and so I suspect they will be into the autumn. They're expecting to get their general approach finished by October time. We'll be in trialogue, therefore, before Christmas. But my suspicion is we will not finish trialogue, and we will not get the detail of this enormous dossier finished until probably the year after. So I suspect it's going to be September next year by the time we finalise it. The good news is that the SME growth market component of it will allow existing markets operating for SMEs to actually convert into an SME growth market. And therefore, the timing of implementation for that is likely to be very short. And so I think it's getting the legislation, the signatures dry, and then allowing ESMA to set the technical standards in place. But it should be quite quick. It shouldn't be too delayed in terms of implementation once we've got the legislation actually there. Definition of SME is a really difficult one. The rapporteur changed the definition that was in the Commission's text. He changed it to that of state aid definition in the EU. And I have spent a long time trying to explain to him that that does not work. You cannot limit this by number of employees and turnover. It just does not work. You need to have a market capitalization over a certain number of years to allow those high growth stocks to benefit long enough so that they can actually grow within that category. And so we are actually trying to persuade him that we need that market capitalization figure in there. And actually more than that, I would take the number higher than where the Commission originally started and take it to a bigger market cap. We are working on it. I can't guarantee he will come round, but I will try my damnedest to make sure he does. How do we make sure it stays there? I am one of the shadow rapporteurs, which means I get to sit in the room for all compromise discussions. I get to sit in trialogue all the way to the very end, and the Parliament has co-decision, so we don't sign off on anything unless we're in full agreement with it. And I can tell you it is one of my key points. It's relatively minor in the big scale of what's out there, but the potential impact of this going forwards could be very, very large. The Commission recognises it, the Commission are on side. It's now a case of making sure all the parliamentarians understand the significance of it and support it. But I, again, will do my best to make sure it's there. I think that was
one
the questions
final
down
question.
here.
One final question. There we are.
James Bromhead from Espirito Santo. I work on the Capital Markets Desk. My question, Dr. Swinburne, is that your speech was all about growth markets and the growth of the SME growth category for Europe. The key driver which I missed out of there is no market for entrepreneurs to actually fund themselves across Europe. I've had first-hand experience of French companies coming to London, being put off by their MEPs and their MPs, and it goes into Germany and everywhere else like that. America works because it has the National Association of Stock Dealers Automated Quotes, NASDAQ. Why don't we have something like that here? Because even though AIM is a great success and has now moved on to internationally, as you rightly put, there are huge structural issues in Europe in terms of how the markets work. And I was quite amazed that you really didn't cover that in your presentation, because without a market which can work across Europe, we've got no hope of really funding the entrepreneurs across Europe.
Well, there are many initiatives for making this pan-Europe at this point in time, and an SME growth market does not need to be national. It's on an MTF model, which means it can be pan-European trading. It does not have to be specific to a national jurisdiction. And more than that, under the CSD regulation that's going on at the moment, that will be written by the Parliament by myself in the next couple of weeks, that actually gives us the scope to do cross-border issuance. And so you'll also be able to choose where you actually issue your stocks through CSDs as well. There's a lot of scope here to make this pan-Europe in terms of this particular growth market. But you're also, in terms of trying to get the entrepreneurs early funding actually on their way. The EU is currently trying to put its own money into a venture capital fund in order to try across Europe to stimulate the early investments and then to actually give them the helping hand they need to actually get them to the stage where they're prepared to actually enter an SME growth market. So they are seeing the continuum, they're realizing where the bottlenecks are, and they're actually trying to put them in place. The problem is it's piecemeal, and they really should be doing it as a one big holistic piece of work rather than step by step. But something is better than nothing at this point in time, so I'm not discouraging them, but we're also trying to make sure that they do join up all of those dots. When I look at the US market right now, I'm not encouraged. I have to say that the number of stocks they're listing in the US and the number of growth companies coming is diminishing. And I spent last week with the European exchanges at their annual general meeting and spent a lot of time talking to the NASDAQ guys there. And they are really concerned that their markets are not working anymore for bringing the growth companies to market. And so they're re-looking at the way they do things, and they're going to have to start from scratch. But NASDAQ tell me that the small companies are now less than 1% of their revenues, and therefore they're very reluctant to spend any management time and any funding to actually try and look at redesigning the marketplace. Now that is a really sad state of affairs, but we are seeing initiatives all across Asia right now, and I actually think we probably need to look at some of those initiatives and actually take some best practice from there as well in order to make sure we have a really stimulated market. But Pan-Europe is the intention of these SME growth markets, not necessarily a national platform.
And I think we should draw this to a close.